Good afternoon, everyone. Welcome to the June meeting of the MTA Finance Committee. Before we get started with the agenda, I'd like to do a couple introductions. As many of you know, toward the tail end of the state legislative session, the legislature and the New York State Senate take up the issue of nominations for public authority boards. And we had a number of nominations and confirmations occur. And I'm welcoming two new board members today, Veronica Vanterpool and David Jones. So, welcome aboard. I'd like to call the meeting to order. Are there any public speakers, Doug?
Yes, sir. Murray Bowden is here today.
Mr. Bowden?
Good afternoon. Finance is about money, if I remember correctly. And money is being handled differently these days. We're in a changing world. The English are going to vote on Thursday whether or not to leave the common market, the European Union. It's significant because there's a realization that the way people deal with money and the control of money, they're furious that rules are being made in Brussels that impact the British people, and they have nothing to say about it effectively. Well, this has been happening around here, and what I've said this morning in 3 other meetings are, essentially, you're not paying attention to what people need. You're doing it the same way you always did, and the way that some outside forces are dictating. And it's not working. In the Railroad Committee, Long Island Metro North, I was discussing the railroad lights and the fact that there are 2 different sets of lights at railroad crossings, which is absolutely not necessary nor legally necessary, because light rail in Boston, Dallas, and Atlanta all have traffic lights. So if you can have traffic lights in Jersey City, why can't you have traffic lights on the Long Island? The weight of the railroad car makes a difference. That's financial, because it's causing accidents, because people aren't paying attention anymore. We're talking about a world where the perceptions are different, where the world is run by Twitter. I don't have a Twitter account. It's changed. And how the culture of various instances. Tom, you're doing a magnificent job in making changes in certain areas where you can make changes. And I realize that in other areas, the culture has to change. It's not the rules so much as the culture and how people perceive of them. So I get to stand here in a Port Authority in a week, and the New Jersey Turnpike and New Jersey Transit and the Thruway, and I get to say, think about how you do things today. The way we did them for the last 50 years may not be correct in today's environment. Robert Moses, for what he designed in New York City, may have been somewhat appropriate at the time he designed it, but it no longer works. We no longer have to see the traffic going in the other direction. They called them parkways because they were ribbon parks. They're not parks anymore. They're arterials and ways to go. And we don't need to see the traffic on the other side. And the people who live near these roads don't have to see them. And you shouldn't be cutting the grass between the community. And New York City is making wonderful access at 155th Street to get to the river for the people that live up there. So my charge to you today is think about doing things differently. You've all sat at a traffic light because people were texting, as Chuck is doing right now, and not paying attention. I saw you. He's a good guy. That's the point. You gotta pay attention, because you can't text when I'm talking, you're at the traffic light. We're going to Maine tomorrow because my wife was born in Maine, and historically we just like to go back and enjoy it for a while before the tourists come. So I'm leaving, and thank you all, and there's a great number of people here doing a marvelous job, and I want to thank you all.
Thank you, Mr. Bowden.
Public speaking. You have a copy of the May 23rd meeting minutes. May I have a motion? Second, any comments, additions, or subtractions? All in favor? Aye. Work plan, Doug?
There are no changes to the work plan. So next is Budget Watch. Budget Watch this month, we're going to focus on May operating results and subsidy results through June. The results I'm going to report are very similar to the trends that we have been seeing all year. Starting with passenger revenue, again, we are $9 million below budget in May. The unfavorable variance there is now $46 million, or 1.8%. A lot of that, and we spoke about this last month, was on the transit side, where while they're approximating last year ridership levels, the budget had assumed some growth, so we're falling behind a little bit there, and we also had some winter weather impacts. Everyone else really is at or above budget for the most part. Metro-North was lower for the month because of the fire under the Park Avenue Viaduct on May 17th. Excluding that incident, they would have been above budget for the month and year-to-date. Toll revenue continues to perform well. Positive results in May increased the year-to-date variance to $26 million, or 3.6%. So that's offsetting a little bit more than half of the reduction in the fare box revenue. Expenses continue to run favorably. Through May, they are $162 million, or 3.6% favorable. Again, we have lower costs for labor, fringe, energy, as you know, with the lower gas prices and diesel prices. It's impacting the electric costs as well. Again, this time of year, we see a lot of favorable costs for contractual services. Some of those favorable variances are expected to reverse as the year transpires. Overtime costs have been running at about budget, and they continue to do so. Debt service costs, they continue to run favorably due to lower rates and the issuance of less debt. Some of that is due to the delay in the capital program. Last month I reported that subsidies, for the most part, were running just at about budget. The exception was PMT, which was unfavorable, but we suggested that there was a likely timing thing going on there that would probably reverse, and in fact it has. So now the PMT is at or about budget. So really, if you look at all our dedicated taxes, they're running just at about budget. Our real estate transaction taxes are running a little bit favorably. So I guess overall we're doing better than budget. Most of the things are doing well, with the exception really of the passenger revenue. I'll take any questions. Yes, Andrew.
I'm glad to see, after last month's shortfall, that the PMT is back. Do
Yeah.
you get reports of the PMT county by county, or do you just get the overall?
We get it overall. We do get it overall.
So if a
Yeah.
county was, not
Yeah.
the best in transmitting it to us, you wouldn't know what county that was?
Well, eventually we would. It's not something we get on a regular basis, but we can, in fact, get that information. But again, and I think I talked about it last month, we focus on what we expect to get PMT in the year, and then we look at trends and try to calendarize it, but it's not always that easy. So I think really our forecast probably didn't just get it exactly right in which month the numbers were going to come. But we did get the money. It's just a question of which
So
month.
on a yearly basis, how often do you actually look at county by county?
Well, we do it when we look at the July, when we reforecast really twice a year, in July and November. So that's when we would also be in discussions with the state to find out if there was, in fact, some delinquency issue, which really has not been the case.
Okay.
Yeah.
Thanks.
Sure. Are there any other questions on Budget Watch? Okay. Pat McCoy's here with Finance Watch.
Thank you. Good afternoon. Finance Watch appears on page 20 of Director's Desk for your committee materials this afternoon. First thing to report is our Dedicated Tax Fund Bond Series 2016B. This was a combination of a band takeout, and due to very favorable market conditions at the time, we added some refunding bonds in there. So we added $178.9 million of refunding bonds that refunded $192 million of outstanding higher coupon debt for savings of $39.248 million. So we were very pleased with the transaction. All-in true interest cost was 3.38%. This was managed by Bank of America Merrill Lynch, together with special co-senior managers, MBE firm Loop Capital Markets, as well as the MBE joint venture of Siebert Branford Schenck and Morgan Stanley, and also service-disabled veteran-owned firm Drexel Hamilton. Just to give you some perspective, this was our 6th refunding that we've undertaken since mid-December, when we started to see a drop in interest rates. And in total, we've refunded over just about $2 billion in bonds for savings of about $427 million. So obviously, we've availed ourselves of a very attractive market environment to continue to drive the cost of the debt portfolio down. Next, I'm sorry, you have a question?
Have you refunded any of the auction rate?
No, we have not.
Wouldn't that pay?
Those auction rates are continuing to reset at very attractive rates, well inside of what it would cost us to fix it out in the current environment. So again, we have a plan of finance ready should we see a spike or some anomaly in the market that would raise the cost of those bonds, but at the current time they're performing.
Do we have an average cost for the auction rates?
I can certainly get that for you. I don't have that off the top of my head. Sure. Okay. Yeah. Oh, yeah. Thank you, Bob. On those refundings, in every case, in those 6 instances that I pointed out, we sought and did receive a waiver of the state bond issuance charge for the refunding bonds, and that has certainly helped the economics of those transactions. So, thank you. Just last week, you saw the emails from me with the preliminary offering memorandum and the final. We issued $700 million in dedicated tax fund notes. We broke it into 2 tranches, $350 million coming due March 1st and another $350 million coming due next June 1st. And let me just tell you, these were put out for competitive bid. We saw a total of 370 bids from our syndicate. In total, 10 firms took away notes, and I'll just run down the list here. J.P. Morgan took $200 million, Morgan Stanley $100 million, Wells Fargo $150 million, Bank of America Merrill Lynch $50 million, Citibank $20 million, PNC $75 million, RBC $50 million, FTN $20 million, Jefferies $5 million, and Goldman Sachs $30 million. So these 10 firms took different pieces of the notes. Because of the way we structured the bidding, firms could bid in increments as small as $10 million all the way up to the full $350 million per tranche. So in total, we were very pleased with the aggressive bidding from our syndicate. The notes have an all-in true interest cost of 0.628% to those 2 maturities that I mentioned, March 1st and June 1st. So that transaction is very good. Proceeds of that will be used for ongoing existing approved capital projects. And then as those notes come due, we'll issue long-term bonds to take them out. Next, we're in the market tomorrow with another refunding transaction. This is Transportation Revenue Bonds, Series 2016B as well. We're currently targeting a universe of bonds in the $500 to $600 million range to refund for savings. This will be managed by the MWBE joint venture of Siebert Branford Schenck and Morgan Stanley, and then special co-senior managers Stern Brothers, which is a woman-owned firm, and Academy Securities, which is a service-disabled veteran-owned firm. So tomorrow we'll be in for retail orders, and then the following day we'll have a final institutional pricing, and we'll report that in detail next month. But I just wanted you to be aware of that. You have the preliminary official statement in your inbox, as well as the ratings on that. And then lastly here we have a diesel fuel hedge that we executed on May 26th, again for competitive bidding. We executed 2.9 million gallons of ULSD, and the winning bid was Macquarie Group at an all-in price of $1.62 per gallon. So again, that program, just for our new members, is designed to provide some budgetary certainty for about half of our fuel spend is what we target with the fuel hedging program. So that concludes Finance Watch. If there's any questions, I'd be happy to take them now.
Thanks, Pat. Next, we're moving on to MTA headquarter and all agency items. There are 2 action items, and the first being the request for authorization to issue MTA Hudson Rail Yards trust obligations to raise proceeds for capital program projects. Pat, do you want to talk about that? And that's on page 32 of your agenda book.
Sure. This is a substantial matter, and let me just, if I could indulge you to read the key section of the staff summary for your information. We are seeking board approval of the resolution to issue MTA Hudson Rail Yards trust obligations and to further authorize the execution and delivery of all transaction documents and closing certificates in connection with the plan of finance to monetize the ground lease payments or the base rent and payments for the purchase at the option of each tenant of the fee interests in the Hudson Rail Yards area. The monetization of these payments will allow MTA to currently take advantage of low interest rates and the value of the 99-year ground leases to raise approximately $1 billion in proceeds for the benefit of the capital program. And just to give you some context, the proceeds of those ground leases were programmed into the 2005 to 2009 program, partly, and the balance in the 2010 to 2014 program. Those projects have been advanced, and this is a way to bring that money forward and to really close out that funding necessary for the capital program. These trust obligations will be issued and secured pursuant to a Hudson Rail Yards trust agreement between MTA and Wells Fargo Bank National Association. Wells Fargo was selected after an RFP process for this service. There's an interagency financing agreement by and among the MTA, the trustee, and the MTA-related entities, including New York City Transit, MAPSTOA, Long Island Railroad, Metro North, and MTA Bus Company. MTA has agreed to pay the base rent and fee purchase payments it receives under the leases and certain other amounts to the trustee to secure the trust obligations. MTA will direct the tenants to make such payments directly to Wells Fargo as custodian under a lockbox agreement, and the custodian will transfer these payments to the trustee for payment on designated principal and interest payment dates to the owners of the obligations. The related transportation entities are the operating agencies expected to be benefited by the financing of their capital projects with the proceeds of the trust obligations. And again, this money was programmed into the 5 to 9 and 10 to 14 program. A portion of the proceeds will be deposited into a capitalized interest account for the purpose of paying interest on the obligations during the rent abatement period under the leases. Other than the abatement periods originally provided for under the leases, abatement of base rent is not permitted for any other reason. That's why we believe we have a very strong credit to introduce into the market. Pursuant to the financing agreement for liquidity purposes, in the event a tenant under a lease is delinquent in a payment of base rent, MTA, on behalf of the related transportation entities, has agreed to advance on a monthly basis the amount by which that base rent received during the month is less than what's required by the obligations. And that obligation would extend no more than 7 years, again, should it occur. The cost of the interest rate advances, if any, would be shared by the related transportation entities in accordance with that proportion of the proceeds of the trust obligations. MTA will be reimbursed for the interest reserve advances from amounts recovered from the delinquent tenant. Such interest reserve advances are made from monies available under transportation revenue bonds after the payment of debt service on TRB debt, so it would be on a parity with O&M. Again, should that occur. It is not planned to occur. I'm sorry. Did you have a question?
Going back. As you monetize...
Can you turn your microphone on, Chuck, please?
I'm sorry. As you monetize the leases at Hudson Yards, are you not, in effect, borrowing on tomorrow's income stream from that property?
Well,
Well, what I would say is when we entered into the Hudson Yard transactions, we expected to get the revenue stream, but we also committed that the funding from that revenue stream would go to the 2005 to 2009 program for $622 million. And then we had, I believe, $633 million. And then in the 10 to 14, we committed $422 million, all against the future revenue stream when they were realized. So what we're doing here is we're basically settling up, if you will, with the funding for those two prior capital programs with a transaction today.
Now, is this a precursor to a plan of monetizing leases or the like?
It would be similar, very similar to that.
Are we planning on doing that? Is the
Yes.
question. So, are we doing that for other properties where we have leases?
I wouldn't say in general, but for a large project where we were basically trying to take the capitalized value and use that for the capital program, yes. This would be a
Let me
model.
ask you this. If this is appropriate, and if it isn't, tell me to shut up. All right? I accept it. Is it feasible, is it appropriate to give us a schedule of the leasing and the areas of leasing that you have in mind for monetizing over the course of the next year or so?
This is the only transaction at the current time that we're in a position to really, model it and be prepared to go into the market. I think, as we look to other potential transactions in the future, we could certainly do that. But there are no other immediate transactions on the near horizon.
None of Jeffrey's?
If I may, I think Bob's initial response to your question is pertinent. Most of our revenues from retail leases and the like are assigned to the operating budget. The only lease revenues that go into the capital program are from ground leases effectively. And at the moment, Hudson Yards is the outstanding example of that.
Okay.
Polly?
Pat, I have to admit, I found the staff summary on this board item pretty confusing. Can you sort of, I guess, talk it through in a little more plain English? And I'm trying to understand, was this something that was always intended? Is this a new idea you all are putting on? I don't really have a context for what the vote here entails. I mean, is this a new thing that you were going to do this? Were you always going to monetize?
No, I wouldn't say that we planned that out of the gate. No, I think what we see is some dynamics in the current market that are very attractive for us to do this now. Again, we're fulfilling a commitment from the 5 to 9 program and the 10 to 14 program. So those projects have been advanced and paid for with other proceeds, and this is really to bring forward these long 99-year lease payments that we were entitled to under the agreement with the related Oxford entities. So, there is an enormous pressure on the capital program, both past and current capital programs, with respect to the funding available from different corners. And this particular transaction makes sense, particularly given the rate environment we're in. The progress of development over the rail yards is quite dramatic. Just to refresh people's memory, those leases between the MTA and the related Oxford entities are for the two parcels, the eastern yards and the western yards. Development on the eastern yards is has moved along quite well. In fact, it was widely reported in the news that the first tower, the coach tower, has received a certificate of occupancy, and employees are moving into that tower. Other buildings are under construction. So the next phase of the development really is looking west to the western yards on the other side of 11th Avenue. And I think given the dynamics of the pace of development, the interest rate environment, and the need for the money, quite frankly, that's what really makes this transaction.
But can I ask about the need for the money? Because I think you just said that this wasn't actually what was envisioned all along. And I mean,
let me
yeah,
correct
and
that.
let me just finish the question, and then just to sort of talk about, there is a trade-off. I understand why we may make it, but I think it is worth highlighting between taking a 99-year revenue stream that you'll have for the 99 years versus bonding it all up front in whatever, I don't know, what would be the duration of the bonding period? I mean, it's, you know, look, I understand why the agency is cash strapped, but, you know, we're taking our long-term revenue streams and bonding them for shorter periods of time. It's just worth pondering the pros and cons of that, I think.
Yeah, first, again, this was always deemed to be capital dollars. Any benefit that we got was capital dollars. Whenever we've sold assets, our position has been that we're going to put it back into the capital program. Anything that we generate out of an operating budget, we keep into the operating budget. We've received about $108, $110 million of cash from this project already. That's going into the capital program. This is just really trying to finish out that 2005 to 2009 commitment, which if we don't do this, the other alternative would be we could sell transportation revenue bonds and just use our own revenues to support it. What Pat was saying is this is an opportune moment to do this. The market's right, there's strong interest, we're getting a good credit rating on it, and we can just go ahead and, if you will, just close out that 2005 to 2009 commitment and the 10 to 14 commitment. And I really think it makes sense to do that when we're now looking at a 15 to 19 capital program with risk in it. So again, it's an opportune time to fulfill those commitments. And we just think this is the smart thing, right thing to do. Now, we're only probably going to be borrowing, what, 40 years against about 40 years of cash flow, so we still have cash flow after that. But as the cash flows go in, they'll pay interest and they'll also redeem the bonds as quickly as they can. But we're not certainly bonding 99 years worth of debt, or excuse me, cash flows.
Yeah, one last question on this. Then what would
If the non-speakers could turn your mics off, please.
what would be the alternative? In other words, when this is for the 2005, 2009, 2010, 2014 plan. This money was for those plans. It seems that this is described as something that we didn't anticipate we were going to do. It's just that the interest rates and opportunity is good. What were we planning to do otherwise?
Yeah, depending on how quickly the development would occur, to the extent the development had occurred sooner than it did, we would have had more cash. Again, I said we've collected already about $108 million, and that's available for the capital program. But again, you can't control how development occurs. And so we're now in a place where the development has really, kind of taken off. It looks very attractive. This is be a good time to monetize it. We've always said that we're going to try to realize the value, and securitization is probably the easiest way if the marketplace believes that those cash flows are going to come in a reasonable amount of time so that you can structure, these trust obligations against it. And we're seeing the cash flow coming in. We're seeing the development happen. That's why we're saying it's an opportune time today. The market's ready, and we can, again, receive the proceeds that we need to close out this obligation on the 2005 to 2009 and on the 2010 to 14.
I would just add that with the Hudson Rail Yards leases, there's an ability for the tenant to prepay their lease obligation, should they so decide to do that, only after they've received certificate of occupancy for the particular development. And as I said, on the eastern yards, we've got all the development underway, some of it already completed. So to the degree that we get those accelerated payments, again, it's at the option of the tenant. We have no control over that. That we would structure these obligations so that we could mandatorily redeem a like amount of bonds, so that we don't have obligations outstanding beyond what we're getting from those leases.
I still have a question, because I'm looking at the staff summary here, which says you committed in the prior two capital plans, it sounds like, it says $1.053 billion to come from this project, is that?
That's correct.
Okay, and then it says take advantage of, the MTA will take advantage of low interest rates and value of the 99-year ground leases to raise approximately $1 billion. I don't know that, I don't see a reference to the 40 years.
That's just the structure that we would use to hit that
But it would be
target.
99 years of revenue, or it wouldn't?
Well, that's one of the uncertainties, whether a parcel stays out for the full 99 years, or whether that tenant decides to prepay their lease obligation once they've received the CFO. We can't predict how or when that would happen, so that's one of the uncertainties.
The expectation.
Sorry, Jeff.
Well, I'll just add that insofar as these sites are slated for residential development, it is in fact, for residential condominium development, it's actually necessary for the developer to exercise their fee option in order to form the condominiums under state law. So there's
I can't hear you, Jim.
I'm sorry. I was saying, under state law, in order to have residential condominiums at this location, the developer would have to own the fee. And consequently, insofar as the program calls for residential condominiums, we have a certainty that there will be, in fact, prepayment of the lease payments. Just the timing is uncertain.
I think I don't know, I didn't really understand that. That's not really the question. I'm just asking, I'm just trying to make sure, reading this language, I'm trying to clarify whatever debt issuance you're doing backed by this revenue stream. Is it the 99-year revenue stream, or is it a 40-year revenue stream?
It's a revenue stream that, again, we don't know the specifics of when a parcel might prepay. But if none of the parcels prepaid, those leases go on for 99 years, even after the obligations would be completely, defeased in the market. So to answer your question, yes, 99 years. But the transaction itself is expected to deliver the value for the capital program in that 40-year window. Again, if none of the parcels prepay, those lease obligations would continue on beyond the life of the bonds and accrue to the benefit of the MTA. Again, none of that being programmed into the capital program.
So again, just to make sure, sorry, maybe I'm not catching this. So
Okay.
we're going to take the 99 years worth of lease payments, bond them out for 40 years to pay $1 billion for the previous two capital plans? Have I got that right?
It's simply, yes. So here's the way to think of it, Commissioner. There are ground leases that are there that extend for 99 years, okay? We do not expect that each of those, the tenants or the owners, to leave it outstanding for 99 years. We think some will prepay, okay? To the extent they prepay, we'll get the cash flow in all at once, and that'll go to redeem some of the bonds. To the extent they don't, the cash flows will pay off the bonds well before 99 years. That's the expectation. But we just don't know what these individuals will do. So they'll take whatever actions they want. But that's what we're doing. And again, I have to come back and say, this was anticipated that the Hudson Yards development would provide the funds to give us $1.05 billion for the 2005 to 2009 and the 2010 to 2014. And what we're trying to do is fulfill that, obligation for those two capital programs from revenues coming from, I should say, from proceeds coming from Hudson Yards, and this does that.
Let me just ask you this. Is there advance payment, if I may call it that, their prepayment, is it subject to any present valuing or any other discount from the principal amount?
You want to answer?
Yeah, yes, Chuck.
What kind?
It's part of the original, it's baked into the original agreement. We are meant to be indifferent as between prepayment and leases going to term in the way that the option prices were set in the initial
But
transaction.
it is subject to a lesser aggregate amount than if they had gone out the whole 99.
In nominal terms, sure, but in present value terms, it's equivalent.
Any questions? Any further questions? I have a motion. Second? All in favor? Aye. Opposed?
Okay, we have one other action item. It's the 2016 State Public Work Enforcement Fund Assessment, PWEF. The staff summary can be found on page 210. We are asking the board to authorize a sum of $879,199 representing the state assessment on the MTA and its constituent agencies for the PWEF fund for the calendar year 2016. The number is calculated at 0.1% of the value of public work construction contracts entered into. Monies are used by New York State to enforce prevailing wage law. I'd like to note that the 2016 assessment is lower than what we would have expected because of the delayed approval of the capital plan, and we need a motion for that.
Second. Any comments or questions? All in favor? Aye.
Next, we're moving to report and information items. The first item is the information technology report, and Sid Gelino is here to go through that.
Good afternoon. This is a review of our activities over the last year, an annual report to the Finance Committee. The transformation of IT services into one solid delivery model has been completed. We've unified the service desk. We've consolidated all IT budgets and financials. We established new job titles, descriptions, agreements with MTA unions to relax the scope rules, which allows us to use representative employees across all the agencies. And we've completed and published our strategic plan, which will be a guide for IT as we meet our corporate goals. Next. The service delivery model is we've taken the corporate goals, we've aligned with the MTIT steering committee. We built those goals and that alignment into our strategic plan. And at the end of the day, we want to develop and deliver systems and techniques that have business value. Some of our 2015 accomplishments. A 2015 budget reduction of 6%, which included 59 vacant positions. Savings proposals of $25 million were achieved, of which $10.5 million were permanent and reoccurring. We've upgraded the PeopleSoft system for HR to 9.2. We distributed our strategic plan to our customers. Internally, we reinitiated our performance review for all our MT employees, MTIT employees. We've implemented Oracle's Hyperion. Again, we've got a labor contract agreement with TCU. And we completed an enterprise project framework called ITIL, and that will be the standard that we'll be using to manage our projects going forward. Next slide. Our goals for 2016. Continue with the PeopleSoft upgrade, this time on the financial side, with major improvements to procure-to-pay platform. A 2016 budget reduction of 7%, including a permanent cut of 69 vacant positions, a recurring annual savings of $15 million. Complete the Windows XP computer upgrade to either thin client or Windows 7 devices, and that's 23,000 devices we're upgrading. Update the strategic plan I talked about earlier in collaboration with the IT steering committee and our customers. Upgrade our data security infrastructure. And we've begun rationalizing over 700 different applications, trying to eliminate redundant applications and sunset applications that we don't need. Very important is the review of our agency SCADA systems. Those are supervisory control and data acquisition systems that are normally not under and are not under IT control. They're operational systems like FAM plants and third power rail. Construction of our new monitoring center on the 21st floor of this building. We've outgrown the one we have, and that, again, is to help us with our updated data security, and data center monitoring abilities. Last but not least is create a task force, which we've done to examine our service delivery. We've had major problems with onboarding new employees. It could take us up to 2 weeks to get a desktop out there. So we've got a committee. We're working with our customers. We're working with HR to see how we can speed that up. I just want to spotlight one of the major projects that we're doing, and that's the Office 365 email, and that is email in the cloud. To date, we've done 6,200 employees have moved over to the cloud. By the end of this month, another 2,500 from Long Island Railroad will be moved over. And then by the end of August, 15,000 from New York City Transit will be moved over. Some of the benefits of this is the Office Automation Suite is common. You can use it on-site and off-site. Disaster recovery. The service level agreements are much higher than we can do internally at 99.9% with minimal downtime. Again, it's cloud-based. The security model is government-rated. It meets HIPAA, FISMA, and ISA standards. Mobility, again, you can use it internally and externally. Collaboration tools, whiteboarding, IM chats, all that stuff is built into this product. Plus 50 gig email boxes per account with 1 terabyte of storage for use for OneDrive. That's storage on the outside that you can use. I want to talk a little bit about IT governance. We've got a strong IT steering committee in place. All our major projects go through that. And this is just an illustration of about $81 million worth of projects that have gone through since February of last year. The committee meets every 6 weeks. It's chaired by the CFO, and stakeholders from each agency sit on that committee. And I won't go over this slide. This next one is very busy, but this is just to show we're very transparent on what we're doing at all levels, just how we make our decisions on what projects we do and won't do. We've built a very robust PMO offering here, project management. That project management organization is managing over $400 million worth of IT projects. And this is just a subset of them. The desktop replacement that I talked about, enterprise asset management falls in there. So they manage these projects for us, and they're using both the ITIL and a software delivery lifecycle mechanism to do that. MTA IT remains in the efficient Gardner quadrants for 2016. These are benchmarks that we did against companies like ourselves, both private and public. The first category is percentage of total budget. So the medium would be 3% of the total corporation budget goes to IT. The average in the industry is 3.3. The MTA is at 2.2. The next one is headcount, percent of total headcount in IT versus the corporation. We're at 1.4. The average is 2.6. The medium is 2%. And then the last category is what we actually spend per employee on IT. We're at $5,000 a year. The average is 8.1, and the medium is 7. Next slide. Some of our key challenges. Our number one challenge today is in cybersecurity. That's the biggest threat we have out there, and we're constantly reviewing what we're doing, why we're doing it, and upgrading our capabilities there. I think the second problem that we face, challenge that we face, is recruiting. We're having a difficult time recruiting staff from the outside, getting quality people to come in. So we're working hand in hand with HR to come up with techniques to resolve those issues. Customer improvement, improving what we do for our end customers, getting stuff more done in a timely manner for them is a challenge, and we're looking at more self-service. This is the way the world is going, having our customers be able to reset their passwords and do things themselves instead of getting in a queue on a help desk. And spending, controlling the spending is also a big issue. That concludes my presentations. Any questions?
Sure. Freddie?
Could I just ask one question?
Freddie had a question first. Okay, I'm sorry.
I was just, a very brief one. I was curious when you said we're getting rid of XP. I can't remember when I dumped XP. It's been so long. but we're going to 7. Is there a reason why we're not going to another operating system?
Quite honestly, a lot of our older legacy applications, there's a lot of testing to get them to go to 10, and some of them won't run in 10, and that's some of the issues we even have with 7. Some of our applications are so old they won't run on those devices, so we've got to come up with other techniques. Thin client is a technique where all the processing is done back in the data center. It turns your desktop into a dumb terminal again. So that's where we are with that. We need to finish testing on 7, and we know a lot of applications won't run on 10.
I presume you're keeping an eye on the horizon for when 7 will no longer be supported.
Yes, we are. We've got that timeline from Microsoft. We know when we need to be off that OS.
Chuck next, and then David. Chuck.
Do we have any form of document retention program insofar as it applies to data?
The document retention program comes out of legal. I can talk about there is a policy for both document retention and for email retention. The new email system is building based on that policy.
David?
Yeah, I'm wondering, you talked about 2 factors that I'm wondering if they're connected. You're having trouble recruiting, but you also mentioned that you're paying less than your peers per capita. Is there a connection that you're paying salaries that are below what the market requires for IT?
No, about a year ago, there was a salary survey commissioned with the Hay Group, and they came back with the new salary structure for IT that we have now put in place.
Okay.
No further questions. We'll move to the next presentation. I believe that's Angel.
Yeah, the next is Angel Barbosa is here to talk about procurement transformation update.
Thank you. So, in speaking about the procurement transformation, one of the most important things is to understand the current context for the procurement groups across the agencies. Under MTA executive leadership, there's a number of initiatives that are going on that are very strategic. First and foremost, most critical, is the capital program. The operating procurement groups are obviously have to execute on that. So that's the first and foremost thing that's most important. There is a PeopleSoft 9.2 upgrade, which is impacting them directly as they are both a new platform and they're participating in the upgrade. There is a procurement non-core consolidation where we are consolidating non-core functions in one procurement group at the BSC. And then there's introduction of new methodologies in that consolidation that also are impacting the procurement groups. So 2016 priorities centered around the PeopleSoft upgrade and our P2P implementation, which is a subset of that. We're trying to design and implement standard processes, online interaction with our suppliers. The non-core consolidation continues. We are trying to build a foundation. We have begun centralizing some of the core contracts, non-core contracts. We've actually begun to support Sid, who just presented his organization with an increase of requisitions there. And we actually have a number of vacancies that we are in the process of filling as well. And as far as the introduction of new methodologies, you hear a little bit more about category management. And really it's about methodologies, processes, and generated savings, which I'll go into a little bit more on the next slide. So the P2P implementation itself, again, is a subset of the 9.2 upgrade. We're going to be implementing the 9.2 upgrade, and obviously that's the most critical piece. But as a subset, we want to introduce new procure-to-pay platform. There's 3 new modules that we're implementing. A strategic sourcing module, which will allow us to interact with our suppliers online. Proposals, RFPs, and whatnot can be distributed online and received online. E-supplier connection, which is a self-service model for our suppliers, allowing them to interact with us online, update their information, keep the data up to date for us as well, which is critical. And then a marketplace, which is supplier catalog based, allowing for more transactional procurement activities to be done through a marketplace, actually alleviating the procurement teams from having to be involved in those types of transactions. So just as there are some new board members, and just as a refresher, the non-core consolidation is based on a premise of separating categories between core and non-core. Core being those that are most critical in terms of operations for the agencies, non-core being those that are not or all agency. And you see the slide there just has some examples. Obviously, rolling stock, things in support of rolling stock, bus, things in support of bus, signals, those are core. You look at healthcare, IT, utilities, those are considered non-core. So accomplishments to date, we've designed a new organization. We have we've established agreements and estimated amounts of staff that'll be moving from the agencies over to the centralized group. We've identified non-core contracts and therefore core contracts. We've paid new positions, and we are currently undergoing negotiations with TCU. Briefly, you've heard a little bit about category management, and I won't go into great detail other than to say that it's a way to structure your staff and your organization around high-level strategic categories, and that's what we're introducing at the centralized group. And it takes you through a fundamental process across organizing, analyzing, and then going to the market and having a strategy when you do that. I talked a little bit about some of the efficiencies that we've garnered out of category management. There's several initiatives on the left side of the screen. You'll see the saving categories, all supplies, hardware, a number of other categories. For 2016, we've approximately saved about $18 million. And fiscal year starting in 2017, it's approximately $37 million annualized over the next 5 years. And that was in partnership with KPMG, so they were very helpful in those initiatives. So some of the challenges we're facing, obviously, as I stated earlier, we are tasked with executing on the capital program, the engagement of a PeopleSoft upgrade that is once in every 10 years, approximately, and then support of the non-core procurement consolidation. So your MTA procurement teams are in the midst of these types of strategic initiatives. Normally, they're planned separately. We're doing it all at once. Another area of challenge for us is obviously around contracts. We will be, myself and the other procurement groups will be coming to you at times for extensions that relate to allowing my centralized group to enact those category-based analyses. It tends to lend to more savings. Therefore, we would initially, there'd be some extensions that come to you that ask for a 12 months extension to allow my team to do a category-based approach in the future. The staff summaries will reflect that. We'll be able to answer questions on that, but you'll see some of those as they come along. So next steps, obviously, most critical is the capital plan, and the procurement groups will be obviously executing for that. Support the PeopleSoft 9.2 upgrade. We will be seeking board approval, as we said, for any necessary extensions. We'll continue to identify other opportunities for savings, and then we'll solidify the organizational ramp-up for the procurement consolidation. Thank you. Any questions?
Okay. Next item, Doug.
Thanks, Angel. Next is the contract change order report for the first quarter of 2016. That's found on page 2011. It's also reported to the CPOC committee. The last information item is the final report and information item is the draft of the independent accountant's review report of MTA financial statements for the 3 months ended March 31st, 2016. That will be presented and voted on at the audit committee meeting on Wednesday. That report is on director's desk. It's in the exhibit book, and it can be found on the MTA website at mta.info. And then it's back to Angel with the procurements for the month.
Thank you, Doug. So for headquarters, there are 4 competitive procurements for a grand total of $1.4 million. In particular, there are 2 significant ones. There is a request for an award to IBM for applicant tracking system. It's a software as a service system. There were 10 proposals for this award. The total amount was $431,000, and the contract is for 6 months. And then the other one I'd like to quickly mention is the WageWorks request for award. 3 proposals, 60 months, $700K award. WageWorks operates and manages the tax-favored commuter benefits program. Chairman.
You have a motion? Second. Any comments or questions, any of the procurements? All in favor? Aye.
Next on the agenda, we have Metro North and Long Island Railroad procurements. There are 3 procurements for Metro North for a grand total of $30 million. 2 are non-competitive procurements, 1 jointly with Long Island Railroad for a total of $27.7 million, and 1 competitive procurement jointly with Long Island Railroad to use the RFP process for a total of $3.1 million. Chairman?
May I have a motion? Second. Any comments or questions? All in favor? Aye.
For Long Island Railroad, there is 1 non-competitive sole source procurement jointly with Metro North for a total of $52.5 million. Chairman.
May I have a motion? Second. Mr. Okay. Please note. All in favor? Aye.
For New York City Transit and MTA bus operations, there is 1 non-competitive procurement for testing and evaluation services with a grand total of $1.6 million. Chairman.
Motion? Second. Any comments or questions? All in favor? Aye.
For bridges and tunnels, there are no items. For FIMTAC, there are no items. This concludes the procurements.
Doug?
Thanks. For your information, we also have the MTA Consolidated Financial and Operational Reports, which are found in pages 234 to 287 of your book. Next is Jeff Rosen with Real Estate.
Thanks, Doug. Before I get to the action items, I'd just like to note to you that the Klaus Meyer Food Court is now open in Vanderbilt Hall in Grand Central, and I think it looks wonderful. So between that and Turnstile at 59th Street, there are opportunities for board retail tourism. We have 5 action items this month, which are summarized in staff summaries in your book. Unless there are questions, I would ask for approval of the 5 items.
May I have a motion? Second. Any comments? Yes, sure.
So, Transit Wireless is prepared to wire and have operational by December of 2016 all underground stations. Is that correct?
That's correct.
Will we be getting updates on that periodically, or?
We can certainly provide you with
Because there are
with
several
updates.
stations with cells, but the service is not yet turned on.
Right. Well, I mean, at Chambers
We
Street,
can give you status reports. The governor has been very clear with respect to a number of items that are in our capital program with respect to what we can do to improve connectivity in the subway. This is separate and apart from that, but this is something we report on to the chamber, so we can easily give you that information. Comments, questions? Any further comments or questions? All in favor? Aye. Opposed? Concludes all the business of the meeting. May I have a motion to adjourn? Second. All in favor? Aye. We'll start CPAC in 5 minutes.